Hello, everyone. Thank you for joining today's Year-End Tax Planning Hot Topics webinar. Today's program will be presented by Daniel Mayo and Dominic Salerno. Before we begin, I have a few housekeeping notes. Materials for today's presentation can be found in the toolbar located on the right of your screen. Also, at the bottom of the toolbar, you will see a chat box. All questions pertaining to the webinar content will be answered at the end. We will do our best to address them. There will be 4 polling questions throughout the program. To qualify for CPE credit, you must participate in each poll. CPE certificates will be emailed to you within a few weeks. And finally, once the webinar is over, there will be a pop-up asking you to complete a survey of today's webinar. Please take a moment to complete it. It is our way of being able to provide you with the best and most relevant programs possible. With that, I'm going to turn it over to Daniel and Dominic.
Thank you very much for that. My name is Dan Mayo, and I'm a principal at Witham Smith & Brown. I'm a member of the National Tax Services Group, and I oversee federal income tax matters in the group. I spend a lot of time doing research, writing, speaking, that sort of thing, and also giving advice, reviewing tax returns, and giving year-end planning advice as well. Dominic?
Thanks, Dan. I'm Dominic Salerno. I'm a tax manager here at Witham, and I predominantly work in the pass-through area and have been in the industry for a little over 10 years. And I'm going to be focusing on more of the business side of the presentation today, and Dan's going to be leading off with the individual portion. So with that, Dan, I'm going to turn over to you so we can get started.
Great, thanks. So we're going to start today, the presentation we're going to deal with today, we're starting with the individual planning ideas and then the business. But first on the individual, before we start that, I want to remind everyone that we're going to highlight some of the year-end tax planning ideas that we think are most relevant to the audience, but it's not everything. And we have prepared a comprehensive year-end tax planning guide for 2019 that deals with individuals, businesses, international tax, state and local tax, and transfer pricing. And we will send that document around to the audience when it's in the next day or so by email. So you can look for that in your inbox. So we're going to start today with the general advice for year-end tax planning is always to defer income and accelerate expenses. And, that's really traditional advice that's always, usually it's the best advice, not always. Sometimes you can affect limitation items, but by doing that, you hope to defer income tax and possibly eliminate it if you can get yourself into a lower rate the following tax year. But when we get into specifics here, the first thing, especially for 2018 and 2019 now, is how to maximize your itemized deduction, given that we have a larger standard deduction. So for 2019, the individual standard deduction is $12,200. Married filing jointly is $24,400. And, given these are very large standard deductions, there's no longer personal exemptions. Planning is really important to really maximize the itemized deductions. So how do we gain the standard deduction? How do we maximize the deductions in 2019 so we can exceed the standard deduction, hopefully get a larger deduction in 2019? So what we really want to do is increase expenditures by year end, by the end of the month. So we'll start with charitable contributions. And the 2 real concepts here, one is bunching. So to the extent you have, you're going to make contributions in 2020 or later years, you can bunch them and accelerate them all into 2019, which will give you a larger charitable deduction. There are limits on the high end, 30 or 50% of adjusted gross income, but assuming you're not running against that ceiling, bunching your deductions is one way to increase the total amount so you can get over that standard deduction hurdle. Similar to bunching is a concept using a donor advised fund, and the way these funds work is you make a contribution today to a donor advised fund. Let's just say you wanted to prepay 5 years of charitable contributions that you make every single year. You would make a contribution today. Let's say you normally give $200 a year and you want to now give $1,000. So you'd give $1,000 today to a donor advised fund, but you wouldn't be required to allocate that money to any specific charities, and you can defer that till later years. So you give the money today. In year 2, you allocate some to one of your favorite charities. In year 3, some to another, and you have that flexibility to allocate the funds in later years. even though you're getting the deduction up front. So that's why it's similar to bunching. With bunching, though, you have to actually give the money to the charity of your choice. It's an actual prepayment. With a donor advised fund, it's a prepayment, but you do have that flexibility to allocate in later years. The next thing we would talk about is with increasing your itemized deductions is possibly to accelerate one or more of your mortgage payments on your home mortgage, your home loan, and mortgage on your residence. And by doing this, if you get an extra month's interest in there, that may be enough to get you over the hurdle, or certainly increase it if you are already over the hurdle, over your standard deduction. We're not really advising that taxpayers really accelerate real estate taxes, right, prepaying real estate taxes and/or state income taxes because of the overall limitation of the $10,000 limitation. And a couple states have recently challenged the limitation in federal court. They lost. We know, I think 4 states are appealing. I don't know if others are going to join as well, but that lawsuit's not likely to prevail. So the overall SALT cap is likely to remain in effect. And most clients we see are usually in excess of that. So accelerating your real estate taxes or state income taxes really don't provide much benefit. And the last comment here on the itemized deductions is medical expenses. If you're in the unfortunate category of having substantial medical expenses that might exceed 10% of your adjusted gross income, or if you're close to the limit of that 10% floor, and it used to be 7.5%, it's up to 10% this year. If you're close to that limit, you might want to consider accelerating some expenses. Maybe you have a medical procedure on the horizon that you need to get done. If you can accelerate it into this year, you can get the expense in and help push yourself over the limit or increase if you're over the 10% floor already. Remember, this is elective, not cosmetic. Very few cosmetic procedures could be considered a medical expense. Like a reconstruction of after breast cancer might be one of them that gets you in there. But generally speaking, cosmetic procedures would not be deductible. But dental work, vision care, and necessary medical expenses certainly can help you get over that hurdle. The next topic we want to talk about is sales or gifts of appreciated capital assets, so stocks and bonds and mutual funds, that sort of thing. And so when we talk about sales, the one thing to think about is try and sell your long-term, called stocks, we'll simplify it, we'll refer to stocks. Sell your long-term stocks instead of your short-term stocks. So long-term means you held it for more than 1 year, so more than 365 days. And if you can hold it for more than 1 year, the maximum rate of tax on long-term capital gain is 20%, and also there's that 3.8% net investment income tax. But that's the maximum. If you're in a lower bracket, you can have a 0 or even 15% rate. But we just want to highlight here, in order to keep your long-term holding period, you cannot have had a straddle up until that point in time. A straddle is when you have offsetting positions in personal property. So it's Section 1092 of the Internal Revenue Code. If you have a stock, if you own, like, say, IBM stock, and you purchase a put option to minimize your downside risk on the IBM stock, that would be a tax straddle. And if you had a short-term holding period in the IBM stock, your holding period would disappear when you put the straddle on. And so any kind of tax straddle will eliminate a short-term holding period and reset it to 0. But if you have a long-term holding period, when you put the straddle on, it will not reset you to short-term. You keep the long-term holding period. So just something to watch out for with the straddle rules. These anti-abuse rules sometimes catch people, trip people up, and they lose their long-term holding period because they did some sort of hedging for a short period of time. When it comes to gifting appreciated securities, if you're gifting to an individual, generally it's better to gift the asset rather than to sell it. And the reason is the donee, the person you give the stock to, gets a tax holding period and a carryover basis. So if you had a 360-day holding period, they succeed to that holding period. And they would also start out with that 360-day holding period, which means they're only 6 days away from having long-term capital gain treatment. They also receive a carryover basis in the assets that are gifted to them. So if you have a basis of $100 and transfer it to your grandson would take that carryover basis of $100. The nice thing about gifting appreciated securities is that the donee realizes the capital gain, not you, when they ultimately sell or dispose of the stock. Of course, this doesn't apply if you donate it to a tax-exempt charitable organization, because they don't pay tax on their capital gains, only on their unrelated business income. But their investment gains generally are tax-free. So that's why when you gift appreciated securities, the general rule is it's better to gift the asset rather than to sell it first and then gift the proceeds. Also, when you gift, some taxpayers, you get the benefit of that lower rate. If they're in a lower bracket, they can receive that lower 0 or 15% rate, whereas you might have been in the 20%, 23.8% bracket. Of course, when you're donating appreciated securities, you need to watch out for the kiddie tax. If the tax is realized by a child under 19 or under 24 attending college, they have unearned income in excess of, I think it's $2,200 in 2019. The kiddie tax will apply. So just something to watch out for. Generally speaking, with gifts to charitable organizations or gifts to charities, you deduct your cost basis unless you have a long-term holding period. Then you can deduct fair market value. So when donating securities, it's extremely advantageous, appreciated securities. It's advantageous to make sure you're only donating stock that you've held for more than a year unhedged, right? That straddle rule also comes into play here. So you need to make sure you have a long-term holding period on the donation. When people are giving these charities, what we advise them is don't wait till the last minute, because it can take sometimes a week or two to get your broker to execute on the transfer and the charity to get the instructions on how to receive it. There can be a lag, so we really do advise people not to wait till the last minute if that's the plan. Using a donor-advised fund, we talked about earlier, it's another way to buy yourself time, so you can choose the best charity. The simple way to think about it is deduct now and allocate later. And so it gives you that flexibility to allocate to your charities at a later point in time. If you're 70, if you've turned 70 and a half this year, then you can also consider donating stock out of your IRA. The benefit here is there's no inclusion on the, let's say you donate stock worth $100,000 from your IRA. There's no inclusion of the $100,000 to you, but you also don't get the deduction. So it's in essence tax-free, and you can reduce your required minimum distribution if you have one. So that's a nice benefit by donating appreciated security in the year you turn 70 and a half and later. So now we switch focus to turning to talk about sales or gifts of depreciated stocks or bonds. We'll call it stocks. So this is stocks in which you have a loss. With losses, you always talk about tax loss harvesting. So it's better to sell the lost stock, realize and recognize the capital loss, and then transfer the proceeds to the third party. That's what you want if you're talking about gifting. But on the sales side, you're always better off selling the assets, realizing the loss. We say that it's good to have losses. By that, we don't mean that it's good that you've lost money in the market, but we mean that if you've already lost the money, it's good that you get a tax benefit from the loss. So you can turn a bad thing, make lemonades from your lemons. Just a reminder, capital losses can only offset capital gains. They can't be used to offset other income, other than $3,000. We'll talk about in a moment. There is planning to be had here when you're talking about offsetting your capital gain, because it's best to use your capital losses to offset short-term capital gain rather than long-term capital gain. So you might want to. This really affects how you trigger what gains you trigger, what losses you trigger, because if you can manage to have your losses offset short-term capital gain, that's taxed at higher rates, taxed at ordinary income rates, whereas long-term capital gain has that maximum 20% rate plus the net investment income tax. So capital losses offset capital gain. It can also offset, once you've exceeded the capital gain for the year, every individual can deduct another $3,000 against ordinary income, like their compensation or salary income. So there is that slight additional benefit beyond the general rule that capital losses can only offset capital gains. When dealing with tax loss harvesting or selling your depreciated assets to recognize the loss for tax purposes, you really need to watch out for the wash sales rule of Section 1091. And what this rule says is that if you purchase the substantially identical stock or securities within the 61-day window period, then your loss will be disallowed. And so the way this works is if you sell the stock, let's say day 31, You look back 30 days to day one, and you look forward 30 days to day 61. And if you purchase the stock within that 61-day period, your loss will be denied, and the disallowed loss gets added to the basis of the new stock. So a lot of people, many people may be aware that if you sell the stock and purchase stock within 30 days after, that triggers a wash sale. But we do remind you that there is a 61-day window, not a 30-day window. So it includes the day of sale, 30 days before, and 30 days after. So if you purchase the stock on day 5 and then sell it day 20, that's a wash sale. And so if you that could be considered a wash sale for purpose of the rules, unless you completely terminate your position. With gifting of depreciated securities, it's better to sell the asset and recognize the loss, because losses cannot be transferred to a third party, unlike appreciated securities. So with the case of lost stock, you're almost always better off selling the stock, recognizing the loss, and then taking the proceeds and then donating them to your favorite charity or friend or family member. They can then take the cash, which is a very high basis asset, to them. So the benefit of doing that is really a double benefit, because you get the tax-saving capital loss, and you also get the tax-saving charitable contribution if given to a tax-exempt organization.
And here's our first polling question. What are the implications of gifting appreciated assets? Donor avoids tax on built-in capital gain. Donee takes a carryover cost basis. Donee receives a tax holding period, or all of the above. We're going to give it a few more seconds as the polls are still coming in.
Remember, we need you to answer these questions in order to receive CPE credit.
Yes, that is true.
I'll hear the answers down here.
84%. Please make sure you submit your poll question. All right, we're going to go ahead and close the poll. Sorry.
Okay, so the results are now displayed. We see that 87% of you got the question right. That's great. That the donor avoids the tax on the built-in capital gain. The donee takes a carryover basis and receives a tax holding period. So very good for that one. So we go now to we turn our attention now to opportunity zone investments and qualified opportunity funds. This is an amazing tax benefit if you have the ability to take advantage of it. And so in a nutshell, what you do here is, if a taxpayer has capital gain, they have 6 months to 180 days to reinvest that capital gain into a qualified opportunity fund and receive a tremendous tax benefits we'll talk about in a moment. But the key here is they only need to reinvest the capital gain, not the entire sales proceeds. So this is unlike the like-kind exchange provisions of Section 1031 that many people are aware of. In like-kind exchanges, right, people can't touch the money. It needs to be done. If someone says, I sold my property and purchased a new property, can I do a like-kind exchange? The answer is no. The ship has sailed. You really need to do that before the transaction, because the seller is not allowed to touch the cash before they buy the new property. With this, the contemplation is that you've already sold something to recognize a capital gain. It can be anything that gives rise to capital gain. And then you can wait 6 months and then take some amount of cash and then reinvest it, or invest that cash in a qualified opportunity fund. There aren't many retail funds out there yet, although we expect to see many in the future. But so what are we think that should be coming, but what are the real benefits then there's 3 main benefits of the investing in a qualified opportunity zone. The first is that capital gain that's already been triggered, realized, can be deferred until the earlier of when you sell your interest or December 31st, 2026. So you get deferral of that capital gain. So that's the first benefit, which is a nice benefit. The second is possible elimination of some of that capital gain that we just talked about a second ago. So if you hold the investment in the Qualified Opportunity Fund for 5 years, then 10% of that gain is eliminated. If you hold it for an additional 2 years, for a total 7-year holding period, an additional 5% or a total of 15% of that gain is eliminated. So you can eliminate a portion of the gain provided you meet the 5 or 7 year holding period. If someone has looked at the prior bullet and done the math, you see that the end of 19 is the last year in which you can make the investment and still get that 7-year holding period before 12/31/26. So if you do want to maximize the gain exclusion of 15%, you need to make an investment by December 31st of 2019. If you make an investment January 1st of next year, you won't be able to reach the 7-year holding period by 12/31/2026. So you still would get the benefit of the 5-year holding period. It was eliminating 10% of the gain, which is nothing to sneeze at. It's obviously a very good benefit, just not maximizing the full 15%. The third and final benefit, which is potentially the most powerful, is you can exclude or eliminate 100% of your gain on your interest in the QOF itself if you hold that for more than 10 years. So a QOF is generally either a partnership or a corporation, and you have stock or a partnership interest. If you hold that partnership interest for 10 years, and there are hedging rules, you can't hedge these things the same way we talked about before with the straddles. There is a hedging rule in the qualified opportunity zone sections. 100% of your gain is excluded from tax. So if you hold it for 20 years, and your let's just say your $100 investment goes to be $10 million, that entire gain is excluded from tax. So it's a tremendous benefit, the investments in qualified opportunity funds. And a lot of people think of it as a real estate play, but it's not. It's not just real estate, because you can invest, these funds can invest in qualified opportunity zone businesses other than real estate. So it's not limited to real estate, unlike 1031 like-kind exchanges are now limited to real estate after tax reform of 2017. But this is not. So as long as the business, there's extensive rules and regulations are out, proposed regulations are out, dealing with how much of the fund must be invested in the zone, and how much of the funds can be invested in other assets, and the ramp-up period. There's a lot of rules for the fund on how to manage itself, so that it complies with the rules and its investors get the benefit. But as an investor, you don't need to worry about that as long as the fund itself is undertaking the diligence to make sure that it meets the rules and all the tests and qualifies as an opportunity, qualifies as a QOF or qualified opportunity fund. So there's a lot of nuance to these investments. A lot of it's going to be managed by the fund you invest in, so it's nothing for you to really worry about on a day-to-day basis. As long as you have a reputable partner and you trust and expect they will manage that aspect of the business, you just need to focus on getting your capital gain invested within 6 months, and hopefully doing it by year end to maximize the benefit. The next thing we're going to talk about is Section 1202 stock, and this is another one of these great perks of the Internal Revenue Code. If you sell stock of certain companies, we'll talk about the requirements in a minute, but you sell the stock, you get to exclude your gain to the extent of the greater of $10 million or 10 times your original tax basis. So if your tax basis was $45 million, you can exclude $450 million of gain. This section is really powerful in the tech sector, and it's where a lot of our clients really maximize the benefit of it. But the rules are, it has to be a C corporation. It can't be an S corporation or a partnership. But if you have a C corporation that has an active trade or business inside it and has for 5 years, and you're one of the shareholders, you acquired your stock at original issuance from the company, then you're eligible for this benefit up to the maximum of the greater of 10 million or 10 times your original basis. There's a lot of nuance to this section as well. You can't switch from S to C corp, but you can take your money out of a partnership and put it in. As long as you get your stock from the company itself, there are ways to maximize that basis, get your basis up to a higher number. And there are also ways, if a taxpayer owns stock, that they can use trusts to maximize that $10 million amount. If that's your limitation, the $10 million, There are things that can be done to maximize that use of those $10 million. You can put it in a couple different buckets and get more than one benefit with the stock that you hold. So this is, I think, the last slide on the individual section. We really, when it comes to year-end planning, really take advantage of the annual gift tax exclusion. It's $15,000 a person. It applies to an unlimited number of donees. Married people can double up their gifts to an individual, although if they come from one person, they have to file a return to split the gifts. It's a simple form you need to file, but you do need to file a gift tax return to split the gifts. But if you can give, again, unlimited number of persons, $15,000 a year cash. The next benefit I want to talk about is health savings accounts. Really, these we're seeing a lot of people use these as additional retirement accounts. And so if you have an individual that has maximized out on their retirement accounts and they have a high deductible insurance plan, they can invest, if you're an individual in 2019, $3,500, a family $7,000 into the health savings account, and then never use that money for healthcare expenses. They let it grow inside on a tax-deferred basis. So let's just say it's a family, married, a couple with kids. They set up an HSA, put in $7,000 this year. All their expenses are paid for outside of the health savings account. They get a deduction of when they put that $7,000 in the account. Then that $7,000 grows tax-deferred over the years. Most HSAs have an investment option, so the money can be put in mutual funds and doesn't need to be kept in a low interest earning bank account. So that money gets invested in the stock market, however you choose, whether it's aggressive or conservative, and that money grows tax free. And if you take that money out for qualified medical expenses 20 years from now, then it comes out tax free. So it goes in with a deduction, it comes out, it grows tax deferred, and it comes out tax free for qualified medical expenses. So triple tax benefited account. After you reach 65, you can take the money out for any reason, but you are subject to tax if it's not used for medical expenses. So this is a great way to enhance someone's retirement savings if they're so disposed. The last thing we'll talk about is conversions of traditional IRAs to Roth IRAs. There used to be a adjusted gross income cap of $100,000, an income cap that no longer applies. So anybody, even billionaires, can convert their traditional IRA to a Roth IRA. Recall that a traditional IRA, you get a deduction up front, but the money is taxable when it comes out. The Roth IRA is the opposite. You pay tax up front, but the money comes out tax-free in the future. So this conversion strategy really is best if you expect to be in a higher income tax bracket in the future than you are today. Some people say, well, when I retire, my income is going to drop. That may be the case, but rates may go up, right? So you really need to consider the political environment and future tax rate changes, as well as you may have pension income, Social Security income. Other things may put you in a higher bracket in later years. The Roth IRA also protects against, so it gives you that flexibility, that diversification against future tax rate increases. What we see is some people like to diversify the retirement accounts. They keep some amount in 401ks and IRAs and others in some amounts in Roth IRAs. Keep it diversified. So they don't know what's going to happen in the future. Figure diversification is the best method for them. So with that, I think we turn now to polling question 2.
Yes, here is our second polling question. What are the benefits of investing in a qualified opportunity fund? Deferral of capital gain, elimination of part of gain if certain requirements are met, elimination of 100% of gain in interest in QOF, all of the above. We're going to give it a few more seconds. The polls are still coming in.
Yeah, it's good to see the vast majority of you are getting this right. The answer is all of the above. And with that, we'll turn it over now to Dominic to talk about year-end strategies for businesses.
Okay, thanks, Dan. Yeah, so as Dan mentioned, I'm going to be covering the business section. First, what we're going to do is just take an overall view of what we're going to be covering. So the main change in the corporate area was that, as of 2018, we're looking at a flat corporate tax rate of 21%. In exchange for some of the cons of the Tax Cuts and Jobs Act, referred to as the TCJA, we got this pro in that there's no corporate AMT anymore. One of the cons to the act was that we now have to be more stringent on our business interest deductions. We'll touch on that in a few slides, and then we're going to be talking about the qualified business income deduction, or QBI, as many of you have probably heard of right now. So the first thing we're going to actually talk about is the ability to change your method of accounting for tax purposes. So most companies are set up on the accrual basis, unless traditionally you were what was called a small business taxpayer. That threshold has been greatly increased as a result of the Tax Cuts and Jobs Act to now $26 million in terms of a annual aggregate gross receipt between a variety of your businesses. There's a few additional hurdles that you need to jump over in order to hit that, but for the most part, it enables a wide variety of businesses that could not qualify for the cash method of accounting to qualify. So why would you want to flip to the cash method of accounting? It gives you the ability to defer your invoices until the next year. So maybe you're not sending out those invoices before year end and having to take that income into account for your tax return for 2019. You can also pay your bills early, giving you the ability to reduce your income by having larger deductions, and make similar prepayments to other types of insurance and real estate tax accounts as well. So this is something that is probably going to be more utilized going forward as people begin to digest the Tax Cuts and Jobs Act. I know in our firm we had some pretty big utilization of that last year, so we're looking forward to being able to save more people money on that aspect. So if we're looking at the next slide, 179 expensing, there's not too much that's changed in this area. Each year this is indexed annually for inflation, so we've gone up a little bit as opposed to what was allowed in the previous year. Note that there is a dollar for dollar threshold when you go above that $2.5 million amount, meaning that any assets that are placed into service during 2019 would be limited in terms of what you could expense as a 179 expense if it were to go over that threshold. So 179 expensing is generally available for most depreciable property other than buildings, which we'll talk a little more detailed about further on in this slide. And just note that it is actually available for off-the-shelf computer software, which a lot of people buy, QuickBooks, other types of accounting method software, et cetera. So the qualified improvement property that is defined in this area is basically anything that's any improvement to the interior portion of a building that's not for the enlargement or structural improvement. So things like escalators and elevators and any other kind of what I like to call the guts of the building, concrete pillars that are holding the roof up, basically is eligible for expensing in this area. What used to not be included was roofs and HVAC systems and security systems, but last year's TCJA Act was able to expand upon this, and now that property is available for 179 expensing. So things to keep in mind when you're planning for this area is, you want to make sure that you not only purchase these assets before year end, but the key phrase there is placed in service before December 31st, 2019. You can't just go out and to the store and buy a bunch of computers or order a bunch of equipment and having it sit on pallets in the back of your warehouse. It's physically got to be placed in service and working. And depending on what it is, you might be able to do that before year end. So if you want to go over to the next slide. The other aspect of accelerated depreciation, much like Section 179 expense, is 100% bonus of first year depreciation. So the real benefit to this is that this can be for machinery and equipment. It used to be only on brand new property, but it's also, as of last year, includable with used property. There are some overall exceptions, but that's generally the rule. The key takeaway here is that any asset life defined in what they call the maker's class life, it's just the IRS's way of classifying different types of assets, is that it has to be a class life that is 20 years or less. So we'll see that buildings are not includable in this area because they have a class life, as we denote on the slide at the bottom, of 39 years. So this particular expense is actually going to begin to phase out. So after 2022, we're going to phase down to about an 80% deduction and a 60% deduction and 20% each year thereafter. So the ability to take advantage of this accelerated depreciation is going to stick around for the next couple of years. So if you're thinking about expanding in terms of a large expansion for your business, you may want to take this into account into your projections because this is not always going to be around, at least to the extent that it is available now. Note that it's not prorated, so meaning that if you bought something now and put it in service and you're able to expense it before the year end, it's not that you'd be subject to a 1/12 limitation just because it's in the month of December. There's no phase out with 179 either, except that 179 is predominantly driven with entities that have business income. So if your company is experiencing a loss this period and you elected 179 expense, that 179 deduction would be carried over into subsequent periods, whereas the bonus depreciation would not be. It's immediately expensable. One of the areas that we're continuing to watch just from Congress is for commercial real estate, buildings and the like. There used to be the ability to classify some of this property as a 15-year life, which would make it eligible for bonus depreciation. The new tax law that was passed last year kind of made a little bit of a drafting error in that it referenced a dead code section. So until they fix this in what's called the technical corrections bill, you're still going to be required to depreciate this property over 39 years and thus not be eligible for bonus depreciation. So that's just something to watch out for. Unfortunately, it's out of our hands, and we would have to wait on Congress for that. So flipping over to our third polling question. Jessica, you want to take it away?
Yes. All right. Third polling question. Qualified improvement property is eligible for bonus depreciation. True or false? All right, we're going to give it a few more seconds as the polls are still coming in. It's a close tie here. All right, we're going to go ahead and close the poll. All right, and it's 57% said true and 43% said false.
Well, I guess I need to do a little bit better job because the actual answer is false. So no bonus depreciation on 39-year property, otherwise known as qualified improvement property, until, like I mentioned, Congress fixes that through a technical corrections bill. So moving on to qualified business income, or QBI, as many of you heard about. Essentially, it's a 20% deduction on what is called qualified business income received from a relevant pass-through entity, or your Schedule C sole proprietorship. And there are some income limitations with respect to the type of business you have. So for most taxpayers, there would not be an income limitation because they're not classified as an SSTB, which is a specified service trader business. So these are the businesses that are in the performance of services in the fields of health, law, accounting, consulting services, financial services, performing arts, and there are a few others in this particular area. Essentially, what it means is if you're in one of those particular industry classes, you'd be subject to these income limitations here posted on the screen. So for 2019, there's a $320,000 income limitation for married filers, and about half of that if you're filing separately or you're single. But like I mentioned, most businesses that are outside these areas are not subject to these income thresholds. You can make $20 million and still be able to claim a QBI deduction of up to 20% of your qualified business income. So if you want to just flip over to the next area, some of the key limitations in this area, how this deduction is calculated. Well, it's limited to 50% of your wages that the business pays, or 25% of the wages that the business pays, plus 2.5% of what they call the unadjusted basis in your assets, or UBIA. Generally, what this means is how much you paid for the asset immediately after acquisition, before any depreciation has been taken on such assets. So some of the key takeaways here, with the wage limitation, is that if you're an accrual basis taxpayer, it's not necessarily what you would be deducting on your tax return to count as the wages for this particular area. It has to be wages that are actually paid. So sourcing that from a W-3 or adding up all the W-2s, which is essentially what a W-3 is, that would be the correct amount to use in this calculation. And then along with the property limitation, there are some additional nuances, if there was a death or any other kind of step up with respect to the property, otherwise known as 743 adjustments. Some of that has to have some careful planning around it in order to be able to maximize the UBIA in that particular area. So if your taxable income exceeds a certain threshold, then your QBI deduction may be limited on the following factors. Again, as we mentioned earlier, if it's a specified service trader business, or what we call an SSTB, mentioned with those prohibited fields. If your business doesn't pay any wages, that's why they put that secondary qualifier in there to take 25% plus 2.5% of the unadjusted basis. So, you see this with a lot of real estate entities. Maybe you have a few different rentals located within one LLC or multi-member LLC. They're not necessarily paying wages, but they do have a substantial amount of property that's being depreciated on the books. Again, this would not apply to land because that's not depreciable. This is just for depreciable property right after you place it into service without respect to depreciation. So some of the planning considerations around this area, as Dan mentioned, obviously the name of the game when it comes to tax is always to try to defer your income in most circumstances to the next year. Always trying to accelerate your deductions. One of the key takeaways with that is now if your aggregate gross receipts from all your businesses are less than $26 million, maybe there's potential to flip to the cash basis of accounting so that you're able to defer your income and take the deductions as you pay them, as opposed to the accrual basis where it's more of on the matching principle. And then the other thing that you could potentially do is increase the wages in the business. Obviously, if you're short of the wage limitation for the QBI deduction, that would be something that you would maybe think about expanding upon. Maybe there's a certain way that you're compensating your employees now, whereas if you were to include that in wages, you'd be able to increase your QBI deduction. So if you want to flip to the next slide. So some of the things to look out for, what we call the crack and pack strategy. They put anti-abuse provisions in the new tax law to where, if you're looking at your operations as a whole, and within one of your revenue streams, you're considered what's called an SSTB, as we mentioned earlier, that you would segregate out that activity in order to, kind of group all the non-SSTB activity in one bucket and then the SSTB activity in another bucket. That actually is prohibited. All that kind of setup would have to be done before the Tax Cuts and Jobs Act was put into place. The UBIA also is sometimes in real estate partnerships could be low in some circumstances. So you have, older property that has substantially appreciated in value, but maybe there's not a whole lot of basis left in this property. So some of the things that could be done is you consider moving the wages from one of your management companies to that particular entity, so that you're able to maximize the QBI deduction. It's best to take kind of a global approach to kind of all of your revenue streams to make sure that you're not underutilizing the expenses that you're actually already paying. So it's just from a structural perspective, it might make more sense to kind of shift things around again, with avoiding any of the anti-abuse provisions that they had put into the law. So UBIA is, I just want to mention, is a year-end test. So deferring an asset sale until the year end, the year after year end, if you're relying on the asset to increase your property limitation. So if you sold all your assets during the year, you're not going to get any UBIA because as this indicates, it's as of year end. So just something to keep in mind. I want to flip over to the next slide. So wages are not QBI to the owners of a closely held business. So one of the things you should think about is trying to reduce the wages for those individuals, which will increase the net income, which would result in a larger QBI deduction, because again, it's fixated on the amount of business income the entity earns. So essentially, from a high level, it's 20% of whatever that business income is. So alternatively, if you were to increase the wages, through a year-end bonus, if you're an S corporation, you could be able to maximize the QBI deduction with respect to the 50% wage limitation that we talked about. One of the things of note, if you're a partnership, guaranteed payments, and if you're a sole proprietor or the proprietor draws, those are not salaries for purposes of the wage limitation. So although they may function in a similar manner, those are specifically prohibited from being includable for that purpose. Just from a high level perspective, we like to think of the wage limitation in terms of a 2/7 ratio, which is more or less somewhat of a perfect ratio between wages and net income before wages in order to maximize the QBI deduction. So in this example here, if we had income before wages was $700 and we paid out $200 in wages, so that $200 times the 50% wage limitation is $100, and then that $500 net profit, which is the 700 minus the 2, times the 20% QBI deduction would yield $100 in QBI deduction. So as you can see here, there was no limit on the wages that we paid out because our wages equals our QBI amount. So this is some of the types of things that we would be doing in a planning scenario. We would take a look at, the wages that are being paid out of the various companies, and then, provide examples and suggestions on how to, maximize underutilized expenses. So if you want to flip over to the next section, which is, with the TCJA Act, there was basically two main provisions for businesses that are most commonly come across. Was the 199A provision for the QBI deduction, which we just talked about, and then the expansion of section 163J, which is the code section that limits, or further limits, I should say, the business interest deductibility. So every business, regardless of the legal entity, is subject to a disallowance on its net interest expense to the extent it exceeds 30% of what's called the adjusted taxable income, or ATI. So for tax years beginning before 2022, ATI, how it's calculated is if you take your business income without any deduction for depreciation, amortization, or depletion, and a number of other items as well. What they do is they take your taxable income, adjust it for, those types of adjustments, and then anything that would be considered not attributable to a trade or business. So if you're, you have charitable deductions that you're paying out of the business, most cases that flows to the individual return, so it's not necessarily an expense of the business. That would be something that would be not attributable to a trade or business. That would be a subtraction of adjusted taxable income, or ATI. And then what they would do is we would look at the net interest expense, which is your business interest expense in excess of your excess business interest income. Essentially, your business interest income would be interest that you earn on your accounts receivable for people not paying timely. An example of, something that may not necessarily be business interest income is if you had an investment account inside the business where you're investing, excess working capital that you decided to set aside for a rainy day for investment purposes. That would be not includable in terms of this calculation. If you want to flip over to the next slide, some of the exceptions to 163J is, again, this $26 million small business exception test. So much like the change in accounting method we talked about, there's a growing theme that, if you're under this $26 million with your aggregate gross receipts across all of your business entities, that you're not going to be subject to 163J at all. There are some hoops to jump over with respect to if you're a tax shelter, basically meaning, 30% of the people involved in the business are passive in nature and they all receive losses, which is kind of common with maybe some large multi-member real estate partnerships. But, with respect to real estate, there also is an exception, or I should say an election out of 163J, which is, if you have a real property trade or business, or if you're in the farming business. Essentially, what that means is, in exchange for not having an interest limitation, you have to subject your depreciable assets to what's called ADS, or alternative depreciation system. So essentially what it is it's straight lining the depreciation that you would otherwise have on a more accelerated basis under what's otherwise known as the maker's depreciation that we had touched on earlier. So, it slows down the rate of depreciation that you can take, but it does not subject your business interest to the interest limitation, which you probably would have if you're in the real estate industry. You have a lot of loans to build out the buildings, which could be quite costly. So I don't think it's too bad of a con in that respect. So if you want to flip over to the last piece here, so for planning around the 163J provision, what you want to look at is consider whether the income is business income or investment income. I mentioned that, if there was investment income being earned on, say, a brokerage account or just a bank account set aside in terms of passive nature, that would not be business interest income, which would not be able to take into account in the 163J calculation. So for entities, we're looking for items that obviously are business income so that we can increase our alternative tax, our adjusted taxable income, or our ATI, so that we could, maximize the amount of interest expense that we are actually paying out. So one of the things that we would look at is look at all of the interest on the trial balance and kind of trace back to see where it comes from. What I would suggest is that, instead of just having one interest income account or one interest expense account, if you want to segregate it into different buckets, if you're an auto dealer, one of the provisions inside 163J is the exclusion for floor plan interest. Obviously, that's a significantly large expense for those types of industries, and that was one of the carve-outs they had. So delineating between the two regular interest and floor plan interest, or business interest income or business interest expense, would be something that would certainly help us as tax preparers and able to maximize the use of all the income deductions that are inside the business. So I think this is the last polling question here, number 4.
Yes. So our last polling question is, the gross receipts threshold for small business exception for 2019 is 5 million, 25 million, 26 million. Who cares? I'm not near that threshold.
Well, we got a few people taking D. That's good.
We're going to give it a few more seconds as the polls are still coming in. Make sure you put in your last polling question so you get CPE credit. All right, we're going to go ahead and close the poll. We have 63% with 26 million.
All right, and that's the correct answer. Also, the correct answer also is D if you don't apply. But glad to see that some people are not subject to it. So I'd like to thank everybody.
We did have one question that did come in that Dan is going to address. So if you want to stay on for that.
Yeah, thank you, Dominic. A question came in about opportunity zone funds, and it says the question regarded the 10 and 15% exclusions, and then the full exclusion on the qualified opportunity fund itself. So I'll explain the principle. The person who asked the question is correct. There's two actual benefits here. Well, three, right? One is a deferral we talked about. The second benefit is the exclusion of 10 or 15% of the capital gain that enabled you to get into the QAF regime in the first place, so the prior capital gain that was realized already. And the third benefit is future capital gain on the investment in the QAF itself. And that's the 100% exclusion on that, on the investment in the opportunity zone fund. That's what gives you the 100% on that. The partial exclusion is for the prior capital gain. That was sort of the price of admission to get into the regime in the first place. So I hope that answers the question. With that, I guess we're wrapped up. I do want to thank everyone for joining. But on behalf of Dominic and me, we appreciate your attention and your answers throughout the polling questions. And feel free to reach out if any questions regarding any of the material we discussed.
Yes, please just remember to take a moment to complete the online survey. Thank you and have a great day.